Okay, let's invite Geoffrey Dennis, independent emerging market commentator, on the show now. Geoffrey, thank you very much for joining in and wish you a very, very happy new year. So lay the context for us as we enter into 2025. Given the global backdrop, what is the call on emerging markets and India in particular?
Well, I think obviously the backdrop, as ever, is very important globally. And by the way, Happy New Year to all of you also. I think the two things that are going to really drive this in 2025 are tariffs, increased tariffs. We just don't know how much and how broad, but presumably President Trump is going to impose some tariffs, some new tariffs coming forward, which will have an impact, of course, on US inflation. And secondly is the impact of very expansionary fiscal policy in the US on the budget deficit, which is going to go even higher. So my basic calls here are that the bond market will suffer in 2025. I think we're going to see bond yields, 10-year bond yields, certainly at least eventually to go to 5%, maybe a little bit higher. I think that's going to keep the dollar relatively strong. And I think we're going to have as background an okay US economy, not as strong as it was this past year, and where Europe is very weak and where I think China is going to continue to weak. If you roll all that together, I think that's a very difficult environment for emerging market equities. I've been talking about this for the last few weeks, in fact. So my call right now, and I haven't really written up my formal forecast for 2025 yet, but I think we're going to see a down year for emerging market equities. Within that, once again, I think India will outperform. It didn't outperform that much last year, but it did outperform. And I guess often the big call that people make in Asia is India going to outperform China? I think it will. India remains, I think, a good story within what is going to be a very challenging emerging market environment in 2025.
Okay, Jeff, good morning, or rather, I guess it's good evening for you, and thank you very much for shortening your holiday, at least for some time for us. A very happy 2025 to you from all of us here. I thought I heard you say 5% on the yields. We are still at 4.57 and we are hoping it's not going to 5. What makes you think it should go to 5%? And in that case, US exceptionalism becomes really serious. We are all hoping that when Trump actually becomes president, it won't be that easy to both cut rates and raise tariffs. It would be an unprecedented, fiscal problem.
Yes, I do
really thinking 5% can happen?
Sorry, yes, forgive me. I do think the Fed is probably going to cut rates a little bit this year. Maybe twice if we're very, very lucky. But at the end of the day, what drives bond yields higher for me is quite simple. Tariffs push inflation up at the margin, probably not by much, but by enough. And the really big issue for the bond market, I think, in the US is going to be supply, given that the fiscal deficit, given what Trump is saying anyway, is likely to widen further, which is going to put upward pressure on bond yields. And I think markets have to deal with that. Now, obviously, we've seen quite a big move recently anyway, and I don't think the thing is going to blow out terribly, but I think we're going to settle at 5 or maybe 5 plus over the next several months. And I think that is going to keep the dollar strong. I think we're going to see a test of parity against the euro, because Europe is so weak and will suffer if you do get some increased tariffs on European exports into the US. And this is just not a great environment for emerging markets. And that's what the call is. It's inflation and a higher deficit. That's what gives me the higher bond yields.
Hi, Jeff. Good morning and good to see you in. Happy New Year to you, and looking forward to chatting with you all through the year. The next couple of weeks is going to be important, right? We'll have to see whether or not Trumponomics 2.0 can do what Reaganomics did many, many years ago. So we'll wait by for that. But in terms of markets and equity markets, I think the Taiwanese index was something that you were a little bit more positive on as well. So where does India come in the pecking order for you?
Well, I think that, first of all, there is a potential silver lining here. Well, two things could happen. First of all, Trump can be all talk and no action. We might not get as much in the way of tariffs and fiscal expansion as people fear. So let's accept that. And also, of course, you may get a nice boost to the US economy because of things like deregulation. But right now, I think the central case has to be the one I've laid out. Now, I think the US equity market does okay. I mean, it doesn't do anything like as well as it's done the last 2 years. But if you ask me to pin the US equity market, I'd say it's probably rises in the single digits. And I think therefore tech, I think, still does decently well. So I would still like to be pretty long as far as Taiwan is concerned. But, outside of that, I've liked ASEAN for quite a while, the ASEAN markets. Malaysia's been a good story in 2025. I think there's scope for those markets to do well. But I think in all of this, I think India really looks pretty good. Now, you talk, of course, all the time about a weaker rupee, and I get it because the numbers, keep going up, rupee to dollar rate. But if you look at the pressure that's being put on the Mexican peso, the Brazilian real, for example, they're much, much greater than the pressure being put on, for example, the Indian rupee. So I fully expect to see the Indian currency holding up better than a lot of other emerging market currencies. And I think while FII money is probably going to flow in and out, it's going to be a choppy year, I still consider India to be a market that probably rises in 2025 against an emerging market asset class, which I think does go down.
Okay. Jeff, pleasure speaking with you. Thank you very much for starting off the year for us with your advice. And once again, hope you have a great 2025.
Thank you, and you. Very many thanks.